Hi everyone, welcome to the Patient Wallet channel. Today we are going to be looking at the market. I'm going to be going over what data points I'm monitoring, how I think about it, and what I am doing about it. The S&P 500 year-to-date return is 7.9% as I'm recording this video and has had an incredible run since about a month ago. The start of the year was full of uncertainty given the war with Iran, but since the small dip of around 7 to 8% of the overall market, the market has come back and it's even stronger. We have the big players including Microsoft, Apple, Amazon, Nvidia, Google, and many other companies reaching all-time highs, but at the same time, people, including myself, are starting to be worried about the valuation multiples once again. This chart shows the 12-month P ratios for the S&P 500, and as we can see, is close to 29 to 30 times. The 5-year average trailing 12-month P line, which is the green line, is much lower and closer to 24 times, and the 10-year average is also much lower and below 24 times. So when I look at this chart, it seems that the market has overextended. The same image is presented when it comes to the forward P ratios, with the market now closer to 21 times, with the 5-year and 10-year averages being 20 and 19 times. The good thing here is, given the difference between the trailing and the forward Ps, the market is expected to grow its earnings pretty significantly. However, this image of overextended market becomes less obvious when you look under the hood. We have a chart here which shows the forward 12-month P ratios split in sectors. As I mentioned earlier, the forward P of the S&P 500 is well above the 5-year and 10-year average, but that's not the full picture when you look at the individual sectors. The S&P 500 forward P is above the 5-year and 10-year averages. However, there are pockets within the market that's not the case. And specifically, I want to talk about the information technology sector, which has a forward P of 24.6, which is below their 5-year average of 25.8, however above the 10-year average of 22.8 times. Real estate, utilities, and materials have almost Ps that are very similar to their 5-year and 10-year averages. Healthcare sector has a forward P that is in line with their 10-year average and below their 5-year average, and the remaining sectors have higher forward Ps when compared to their historical ratios. We've seen from recent earnings, the big tech companies reported exceptional results, with most of them re-accelerating their revenue growth, and at the same time we are looking at their forward Ps being below their 5-year average. Even more importantly, in my opinion, net profit margins are going up. So looking at the trailing and forward Ps in isolation, you might be able to say that, the market is overextended. However, when you start taking into consideration net profit margins, you can see that the majority of the sectors are becoming more profitable. So for every dollar of revenue they are making, more money lands as a net profit. Sectors with improving profitability includes information technology, communication services, financial, utilities, industrials, consumer discretionary, and materials, with the remaining sectors including real estate, healthcare, energy, and consumer staples having either the same profit margins or below what they used to have back in Q1 2025. And again, information technology, which is the biggest weight in the S&P 500, increased their profit margins to 29.7%, which is a very good increase relative to their Q1 25 number of 25.4%. In addition, the strength of the S&P 500 is supported by the earnings reports we have seen up to date. Information technology sector reported earnings, and none of the earnings were below estimates. Information technology companies delivered. 6% of the earnings reports were in line, and 94% were higher than the estimates. Information technology sector performed the best, but regardless, when you look at the remaining sectors, the picture is positive. the majority of the companies reported earnings above expectations, as we can see from these green bars here. And in my opinion, we continue to see earnings being strong and continuing to grow. The market has a long way to go. So the S&P 500 trades close to all-time highs. The P multiple relative to the historic averages is overextended. However, at the same time, we've seen profitability improve in the majority of the sectors in the S&P 500, being led by the information technology companies. And at the same time, the earnings season today has been very promising, with the majority of the heavy hitters exceeding expectations. So as we can see, the 12-month EPS and the price are moving in sync. We've seen the forward 12-month earnings per share number climbing and growing faster than earlier years, which at the same time pushed the S&P 500 price even higher as well. Now I think the market is clearly split in a few camps. We have the SaaS companies performing terribly. We've heard about the SaaS apocalypse for a long time now, and the market expects AI will disrupt their businesses. And as we can see, the 1-year performance of a lot of SaaS companies being heavily in the negative. Trade Desk is down 15%, Adobe down 34%, Salesforce 34%, Intuit 39%, and so on and so forth. Monday is one of the worst performing stocks out there, being down 74% in the last year. The opposite camp is the AI supply chain. So which company is critical in this new AI revolution? We have Sandisk up 4,161%, Iron up 788%, Micron up 779%, Nebius up 527%, Intel, AMD, ASML over 100% gains in the last 1 year. These are exceptional results for these companies, but it's clear that the market expects SaaS companies to be obliterated, whilst the stocks in the AI supply chain, there is no price too high to pay as of today. It might be justifiable or not, but in my opinion and experience, pendulums tend to swing too far out in the extremes, and that's the case for both SaaS and the AI supply chain as we speak. And of course, the last camp, in my opinion, is the AI funding players, which is the big tech, Google, Amazon, Meta, and Microsoft, the so-called hyperscalers or the heavy Capex hitters, as they are spending a fortune to expand their AI use. Another way to think about this is, you have these big tech players that are extremely profitable funding the next AI wave, which essentially leads to the rise of AI, which is the risk to the SaaS companies, and the cash flows are flowing to the AI supply chains, which, as I mentioned earlier, is the Sandisks, Microns, and Nebiuses of the world. The question we need to answer though is, when does this music stop? We know that the Capex spend of these companies is expected to double relative to 2025, taking us to $800 billion in 2028. So we've seen during this earnings season, Capex numbers are continuing to increase, and the market expects these Capex numbers to go to $800 billion in 2028. If we see this Capex cycle overextend and continue to see upward revisions of these Capex numbers for years to come, I expect the same trades to stand today. If not, I expect the pendulum to swing back closer to the middle, and you would see a rotation away from the AI supply chains towards other sectors and broader sectors within the market. Now, what macro data am I looking at to try and gauge if this rally continues? A fundamental point is the Treasuries yield curve, with the short term being controlled by the Fed and the longer term by the markets. Generally speaking, if the Fed lower rates, I expect the market rally to continue, and if the 10-year plus yields fall, it's a very similar idea, and I expect the markets to continue to rise. Obviously, we have the new Fed, so I don't know what the actions are, but the new Fed, I think, will be driven by the data. So if we see lower inflation and weaker labor market, the expectation is the Fed will be lowering rates and the markets to rally. But if we see higher inflation and strong labor market, the Fed will have a tougher job to lower rates. But keep in mind, the short-term yield curve is controlled by the Fed, but the longer term yields are controlled by the markets, impacted by growth and inflation expectations. Currently, the 10-year US Treasury yield sits at 4.4%, and it's very close to the highest levels we've seen over the last 10 years. If we see this number come down, I think there is much more room for the markets to rally, simply because investors look at this number and compare the 4.4% return versus what they can get from the market. And of course, given the war in Iran, we have crude oil being close to $100 per barrel. Of course, crude oil impacts all economies around the world, but the way I think of this is pretty simple. Crude oil flows into supply chains of everything, so the longer this number remains high, the more likely that we are going to have higher inflation, which will not allow the Feds and the central banks to lower rates and will squeeze consumers. At the end of the day, in my opinion, the markets reflect consumers' strength. If consumers' financial positions are not strong, it will impact the wider market over the shorter to medium term. So if the war is resolved, I expect crude oil to come down and the Fed will have an easier job to cut rates, which means the markets rally. If not, and the longer the crude oil lingers around 100 or even higher, I expect this to be impacting inflation, making the Fed and other central banks' jobs tougher to lower rates. Some of them might think of raising rates given inflation, which will not help the markets. So that's how I view the markets today. And obviously, this image is reflected in my portfolio. So let's look at my portfolio quickly. My portfolio value sits at £40,400 with a return of 4.35%. As you can see, my portfolio reflects how I think about the markets today. I have close to 50% of my portfolio allocated in the big Capex spenders, which is Amazon, Google, and Meta. And the reason is pretty simple. I think their Capex spend today improves their modes and reaccelerates their businesses. And at the same time, these companies have optionality that I think the markets don't appreciate. And if I can talk specifically for Amazon and Google, AI or not, their Capex spends today is to expand their modes because they are building out data centers to serve customers that are already committed to spend money. These are the remaining performance obligation numbers we've seen in their recent earnings report. And these are ultimate beneficiaries of these AI waves. They can use AI to essentially improve their products, but at the same time, host these AI workloads on their cloud infrastructure. And lastly, these companies are also involved in robotics. I think robotics is the next wave and we will see it come online in the next 5 to 10 years. And I still expect these companies to be massive beneficiaries. Then I have two companies which I would call them pure SaaS apocalypse companies, which is Adobe and Intuit, which account for roughly 21% of my portfolio. As you'd expect, their performance has gone down with the rest of the SaaS companies. I don't think AI disrupts Adobe's or Intuit's businesses, but I do expect it to help them grow much faster and improve their margins longer term. But then we have FICO and S&P Global, which the way I categorize them is essentially as yields and rates come down, these companies should be massive beneficiaries. We've seen S&P Global benefiting from recent debt issuance from the Capex spenders in the last quarter. And for FICO, we've seen their price power continue to play into the fundamentals, growing exceptionally well over the last quarter. And lastly, we have Netflix and Auster. Netflix, I think, has plenty of room to grow going forward. It doesn't fall into a specific category, but I expect it to grow market share, expand its market, and continue to raise prices, which means this company will continue to compound well into the future. And Auster is my most recent addition, and is probably a company I will be talking about in a future video. So that's it for this episode. Thank you for watching, and I'll see you in the next one.